You might think you're doing everything right, saving a little, paying your bills, but what if unseen money mistakes are silently draining your future? The worst part, you may not even realize you're making them. Hey, this is Zero to Wealth. I break down personal finance in ways that don't feel like a lecture, but actually help you fix what's holding you back. Today, we're going to uncover 7 common money mistakes that are trending right now, mistakes that many people don't even know they're making. By the end, you'll know how to spot them and course correct. Mistake 1. Underestimating the cost of credit card debt. One of the biggest hidden traps is credit card debt. If you're carrying a balance, you're not just borrowing, you're slowly bleeding value. The latest data shows that U.S. credit card debt has climbed to $1.233 trillion. The average American who carries a balance now owes around $6,500 plus per person. Meanwhile, the average interest rate, APR, on these balances is sky-high, more than 22%. That means when you make just the minimum payment, most of what you pay goes to interest, not the principal. In fact, with a $6,500 balance at 22%, paying $150 a month could cost you double in interest before it's paid off. Many people treat credit cards like a short-term convenience, not a long-term compounder of losses. But when that debt lingers, it sabotages your saving, investing, and your long-term wealth potential. How to fix it? List out all your credit card balances plus APRs. Use a payoff method, avalanche or snowball, to eliminate the worst debt first. Avoid adding to that balance. Freeze the cards if you have to. Reallocate money that would go into fun spending into paying off high-interest debt. Mistake 2. Misusing buy now, pay later, BNPL, options. Buy now, pay later, BNPL, used to look like a safe, interest-free way to split payments. But lately, it's becoming a serious financial risk. Here's what's happening in 2025. Over 25% of Americans regret using BNPL because the total cost ends up being more than they expected. Nearly 24% of BNPL users have missed payments, which means late fees and piling debt. According to another study, 63% of users have active BNPL loans, with multiple providers, stacking up their obligations without even realizing the total. On top of that, some users actually have higher credit card debt. BNPL users carry, on average, $871 more in credit card balances than non-users. BNPL isn't just a buy now, pay later solution. For many, it's becoming a stealthy debt accumulator. How to fix it? Treat BNPL like a loan. Write down what you owe across all providers. Create a simple repayment plan. Prioritize BNPL balances as you would credit card debt. Avoid using BNPL for non-essential purchases. Ask yourself, do I really need this now? If you're already using BNPL, automate your payments so you don't miss due dates. Mistake 3. Not building a real emergency fund. Another big one, no real safety net. Many people think a rainy day fund means a few $100 in their checking account, but that's not enough when real emergencies hit. Economic pressure is building in 2025. Inflation remains sticky, and interest rates make debt more expensive. According to a KPMG report, consumer credit, especially revolving debt like credit cards, is rising again. Lower and middle-income households are especially squeezed. Some lack enough savings to absorb common shocks. Without a strong emergency fund, a car repair or medical bill can force you onto credit, undoing any progress in saving or investing. That's how small missteps become long-term financial damage. How to fix it? Start with a starter fund. Aim for $500 to $1,000 in a separate, easy-to-access savings account. Automate every paycheck, transfer a fixed amount into that fund until it's built. Once the starter fund is full, scale up to 3 to 6 months of essentials, rent, bills, food. Treat this money as untouchable. It's insurance, not spending cash. Mistake 4. Ignoring your budget, or assuming it's enough to just track expenses. A lot of people believe that just tracking their spending is enough. But tracking without structure is dangerous. It's like watching water leak without plugging the hole. Here's what often goes wrong. You see where your money goes, but you don't allocate it intentionally. There's no plan B for extra cash. So any windfall or side income just vanishes. Without automation or priorities, it's too easy to forget, to save, or to miss time debt payments. In 2025, many people have side hustles or gig income, but unless that extra money is routed strategically, it often just fuels lifestyle inflation. How to fix it? Choose 1 to 2 core systems. Automate your saving, investing, and debt payments. Use a money dashboard, spreadsheet, or app to divide your income into buckets: essentials, buffer, investments, debt. Do a monthly review. Check what came in, what went out, and adjust your automation if needed. Set up rules. For example, any extra income must go to debt repayment first or to your emergency fund. Mistake 5. Letting lifestyle creep take over. Lifestyle creep, that's the gradual increase in expenses as your income rises. That small upgrade mentality is one of the most common silent wealth killers. Why it's especially dangerous now. Subscription services are everywhere. Streaming, fitness apps, premium tools. Brands encourage upgrades. New model just dropped. Limited edition. People rationalize spending because they deserve it or they've earned it. Inflation and higher costs make discretionary spending more tempting. Might as well treat myself. If your expenses grow every time your income grows, your net worth may never catch up. You're effectively funding your lifestyle, not your future. How to fix it? Do a quarterly billing audit. List all subscriptions, recurring payments, and recurring purchases. Implement a wait 30 days rule for upgrades. If you still want it after a month, then decide. Redirect any extra income from raises or bonuses into savings or investments first. Set a lifestyle budget, what you allow yourself for wants, and stick to it. Mistake 6. Not investing consistently. Many people believe that investing is for the rich, or that you need a huge lump sum to start. That's just not true, and it's one of the biggest invisible mistakes. Here's what's holding people back. Fear of investing. What if the market crashes? Lack of knowledge. They don't know where to start. Waiting for extra money. When I have more, I'll invest. Over-worrying about timing. Trying to pick perfect entry points, missing that consistent contributions win over time. But investing isn't about outsmarting the market. It's about time in the market, not timing the market. Even small, regular investments compound powerfully. How to fix it? Use dollar cost averaging. Set up regular contributions to an index fund or retirement account. If you have an employer plan, 401k, etc., contribute enough to get any match. It's free money. Automate your investing so it happens without thinking. Keep it simple. Low-cost ETFs, index funds, or diversified mutual funds are often the best place to start. Mistake 7. Neglecting your credit score and long-term credit health. Your credit score isn't just a number, it's a financial signal. Ignoring it can lead to hidden costs and missed opportunities. Common credit mistakes people make. They don't check their credit reports regularly, so errors go unnoticed. They open multiple credit lines without a strategy. They don't think about how BNPL or smaller loans may now impact their credit. Yes, as of 2025, some BNPL providers are starting to report to credit bureaus. They don't consider how future borrowing, mortgage, car loan, depends on their credit health. With more people using BNPL and credit tools, credit risk is rising. And when your score drops, everything, loan rates, mortgage terms, insurance costs, can become more expensive. How to fix it? Check your credit report from the big bureaus, TransUnion, Experian, Equifax, at least once a year. Pay all credit accounts on time. Automation helps here too. Keep credit utilization, how much of your available credit you're using, low. Under 30% is a good rule. Be mindful before opening new credit lines. Have a plan for how you'll use them. Why many of these mistakes hide? So, why don't people see these mistakes? Because most of them are invisible or they feel normal. We normalize debt. Credit cards and BNPL are so common that many people treat them like utilities. We undervalue automation. If saving and investing happen passively, we don't feel like we're sacrificing. But many never set it up. We don't measure the right things. Most people focus on income instead of net worth or long-term financial health. When you start seeing money as a long game, where compounding, systems, and consistency matter more than getting rich quick, you catch the leaks. And that's when you can flip the script. What to do starting now. Here's a plan you can start implementing today to fix these unseen mistakes. Run a financial audit. List all your credit cards, BNPL balances, and recurring payments. Put them in one spreadsheet or app. Automate your money. Set up transfers from your paycheck. A portion goes to savings, another to debt, another to investing. Use automatic payments for your credit accounts so you never miss a due date. Build an emergency fund. Open a separate savings account. Automate $50 to $100, or whatever you can, per paycheck until you reach your starter goal. After that, scale up to 3 to 6 months of expenses as your buffer. Pay down high-cost debt. Use either the avalanche, highest rate first, or snowball, smallest balance first method. Focus first on credit cards, then tackle BNPL. Invest consistently. Open or use an investment account, brokerage, IRA, 401k. Set up recurring contributions. Keep your investments simple. Index funds or low-cost ETFs work well. Protect and monitor your credit score. Check your credit reports. Lower your utilization. Avoid opening too many new credit lines without purpose. Review monthly. At the end of every month, spend 10 to 15 minutes reviewing your money dashboard. Update your net worth, assets minus liabilities, so you can see progress. Tweak your automation or spending as needed. Why these mistakes are more dangerous now. In 2025, the money landscape is more complex and more risky than many people realize. Rising interest rates make carrying debt much costlier. Inflation puts pressure on income and spending, especially for essentials. BNPL usage is mainstream, but it's not as benign as it seems. Many users mismanage it. Credit and financial access are shifting. Credit scores, credit reporting, and lending models are evolving. What this means, the cost of small mistakes is higher than ever. But the good news is also true. Small improvements, repeated over time, compound just as powerfully. If you can catch and fix these hidden mistakes now, you're not just avoiding financial risk, you're building a foundation for long-term freedom. The biggest trap many people fall into is thinking they're okay enough. They believe they don't have major problems, so they don't do the work. But financial health isn't built by accident. It's built by systems, by automation, and by small, consistent choices. Start where you are. You don't need to fix everything today. Pick one money mistake from this list and address it, then build from there. Over time, those corrections compound into something real. If this video helped you spot mistakes you didn't even know you were making, hit subscribe. I break down money in simple, practical steps every week. And if you want a 90-day actionable guide to fix these mistakes, drop a comment saying 90-day reset. I've got you.